Hi, I'm Mike Turner. I've developed a set of rules that I call my 10 essential rules for beating the market. Rule number 7 is institutional ownership, all about whether or not you should consider it, how you should consider it, and how you should look at it with regard to selecting that final stock that you want to own. This is the one that tells you whether or not the big boys on Wall Street like your stock or not. Now you might say, who cares? Well, you should care a lot. Let me tell you why. Large institutions have rooms full of MBA graduates whose job is to do nothing more than find that undiscovered company, that next company that's going to begin moving higher in share price. I know you hear all the time, you get these kind of whisper comments that are out there that Wall Street has missed this particular company, or here's a stock that no one knows about. Well, I hate to break it to you. There are no such companies. Wall Street knows every company. Wall Street knows the big institutions on Wall Street. They know these companies better than you or I ever will know them. And they know whether or not they're going to be moving up in share price, at least in their opinion, or not. But it'd be very, very important, I think, as investors, as individual investors, if we knew what those big institutions were doing and we knew the results of their research. And you can, because what's really fascinating about the market and about the rules that are in the market is that large institutions are required by law to report their holdings. So you can track over time whether or not large institutions own shares of stock in any company you want to look at. In fact, I chart this over time. Let me pull up an example of what I'm talking about on the screen. And you can see here's a company, XYZ, and its amount of institutional ownership of outstanding shares over time. And you can see that it has moved up in some cases and moved down in others. It's very, very important to know whether or not large institutions are accumulating shares or distributing shares. Because if they're accumulating shares, that not only tells you that they've done all the research on that company and they really like what's going on and they really believe that that company is going to move higher in share price, but they're buying more shares. There are more institutions getting involved. That's an extremely bullish indication on that company. On the other hand, just the opposite is true. When you see those shares begin to go down, the percentage ownership that large institutions have in a stock or a company, you'll know that that company is beginning to fall out of favor with the large institutions. And you might say to yourself, why do I even care about that? It's because, keep this in mind, those large institutions really want to make a lot of money in the stock market. They're doing a lot of research which you do not have the time or the money to do. They're doing for you. And it'd be great to follow what they're doing and to get an indication of the directional move that they're playing on that particular stock. And here's what I have developed with regard to a set of rules around institutional ownership. First of all, zero or very low institutional ownership means one thing. The large institutions have reviewed that company and have passed. Doesn't mean it's a bad company, it's just not the best choice. And so you want to really think twice about owning a company that has no institutional ownership. The opposite is almost as bad. If you're way at the top, and let's just say that the large institutions own 95, 96, 98% of the outstanding shares of a company, that means they really love the company. It means that they really believe that that company is going to move a lot higher in share price. But it also means that when they get ready to come out of that company, when they start selling shares, the share price is going to drop. The large institutions, when they pull out fairly rapidly, and that'll have a major impact on that share price. It could fall right through your stop loss. So there's more risk, and this is the important part of this rule. The more institutional ownership there is in a company stock, the more risk is that when those institutions come out, that share price will plummet or fall through your stop loss. So what I have developed, or what I believe is a great middle range, is what I call my sweet spot. And that's between about 30% and 60% of institutional ownership of the outstanding shares of stock of a company. And I like to see that increasing. And if it's increasing, if there's more shares being accumulated by large institutions, if they're in that 30 to 60, 70% range, in that range, I think it's a very strong indication that that might be a great company for me to consider. Now, I will not go out and buy a stock just because of institutional ownership. But when I'm getting ready to make a final decision and I'm narrowing down that list from 6,000 to 300 to 20 to the 3 to the 1 that I'm going to buy, when I'm making that decision of narrowing down the list of what I want to buy, looking at that institutional ownership is a great way to make a decision about whether a stock makes the cut or not of moving into that final group that you want to consider buying.